All right, good afternoon. Matt Davio back again in our interview series today. I'm with Martin Armstrong. Martin, obviously a lot of people are aware of your background. Studying a little bit about yourself before I got on this call with you, and we've talked a little bit before we hopped on. You grew up actually in a very young age, kind of speculating and it's well known in stamps and coins. How did that, I collected baseball cards and a couple stamps, but how did you get into, coins and stamps at a young age as a teenager?
Well, actually, back then, the coin dealer was really the bullion dealer. You could buy and sell gold and silver, but it had to be in coin form up until 1975. But I think also, what kind of drove me into it to some degree was that silver was taken out of the coins in 1964. So literally, as a kid, just going to the bank and going through all the coins and sorting out the silver and then just go selling them.
Yeah, because it was pre-1965. I remember that even as a kid, growing up, and anything before 65 and you had silver in it, you could actually, like you said, sell it for more than the dime it was supposedly worth. So.
Oh yeah, it was the age of the silver certificates. It was like it was a big thing then, and. All it took for money-wise was that whatever, if you had $20 in your pocket, you went down, and for $20 you got a bunch of quarters, you looked through them, and just kept going back.
Right.
So it wasn't, it was a different era.
Were you hooked by the arbitrage, though, and it was in the business opportunity? Was that something that interested you at that young age without you even knowing it, really?
I think so. I think it was just the very interesting activity that took place. Then my father was taking the family to Europe for the summer, and I just wanted to have my own spending money. So I ended up getting a job at this local bullion dealer to earn some money, so I would be able to have some money myself. And then that kind of introduced me to the metals markets, etc., at a very crucial time when they were all just beginning.
Sure.
So, it really kind of changed my perspective in the sense that it gave me a front row seat, so I could see what was actually really happening. And then the problem would be you go to school and what they were teaching in school even back then, they just didn't fit. And even today, you can't go to a university to go get a degree to be a hedge fund manager. They don't teach this stuff.
True. The road education didn't appeal to you all that much then.
Well, it also was interesting in the sense that became very conflict. In the sense that the physics professor was saying nothing is random, there's rules and regulations and laws on everything. And then you basically go to the economics professor and he says, oh, well, it's all just a giant random walk, so don't really try and predict anything.
Right.
And you look at them and you say, well, one of you are lying,
Yeah.
One's telling me nothing's random. You're saying everything's random. Why don't you guys at least talk to each other?
And you're both scientists, right? Yeah.
And I think that really made me see things differently. And then as far as cycles and all, there was a movie I've written about. It's called The Toast of New York. It's an old black and white film, and my high school teacher brought in, I think it was from 1937. And it showed Cary Grant when he was pretty young in it. Okay. And it was about the Panic of 1869. And in here there's a clip, a scene, I would say, where Jim Fisk, it's about a guy who was trying to corner the gold market back then, kind of like the Hunt brothers of 1980,
right?
In silver. And it turned into a real panic. And so in this one scene, here he is with the ticker tape, and gold traded on the New York Stock Exchange back then. And here he is, and he's, has the ticker tape coming, and he turns and quotes to his girlfriend, gold's $162. Now I'm thinking, it's $35. I mean, what is it? I thought at first this is just a Hollywood movie that,
Right.
I mean, because I was at least working in the industry. I knew what the price was.
Right.
But it bothered me, and I went to the library, and I pulled up on the microfilm back then, the New York Times, and I looked for that date, and sure enough, there it was, $162.
An ounce. So in 1869, gold was actually trading there?
Yeah. And it was like, how could that be? I mean, was being taught in school that everything was linear.
Right.
You have inflation that's steadily each year, a little bit more, a little bit more, a little bit more. So all of a sudden here you have something at $162, in 1869 and $35 in 1966. I mean, something just, that linear path didn't seem to be correct.
So where did that lead you?
So then it started, I was curious. So then I started trying to look at these things, because it certainly wasn't linear. And I think also what sparked me in this direction was this was a very, I guess I was at the right place at the right time. You had the panic of 1966, where the stock market really crashes down. It's the first time it hits 1,000. Then it goes back up and hits again in 1968, crashes again into 1970. Real estate market crashes. Then you have, by 1971, the floating exchange rate system is born. Gold has the first two-tier system trading begins in 1968. So it was a very tumultuous period where you didn't go for great lengths of time. It was almost a financial panic every 2 years.
Okay.
So I think that period exposed me to the fact that it certainly wasn't linear.
Right.
And it also made me see that at first you tend to think, okay, fine, precious metals fell, that's precious metals, that's what they do. And then you realize the stock market does the same thing, real estate does the same thing. So I began seeing the same patterns. And I had made some reasonable money in the precious metals, from 64 going into 66. And here my father thought I was maybe a little bit too speculative. And he was telling me I should be conservative and invest in the stock market. So I bought a Fidelity Trend mutual fund at probably the high in 1966 at about $54 and watched it go to $7,
I think I did.
Father.
I think I did the same thing with a Fidelity fund and with my paper out money in 1976 or 7 through 80. I think I saw the same thing with obviously interest rates skyrocketing during that time, and I was 10 to 14, and that's exactly what happened to me, and that was my entree into the same experience. So it's interesting that we have that correlation, because that's exactly, and it was just, luck of the draw where we were in the markets at the time, but I had that similar experience.
Yeah, I think, what causes us to notice things is basically what's taking place. If everything was nice and quiet and not going anywhere, would you really notice?
Right.
Will we start looking at different things, and the answer is probably no. So that non-linear nature of the game, and I call markets a game, much like the non-linear nature of life, then is probably what really attracted you to learn more about this business. Well, yeah, and I think when you begin to look around, you see there was nothing that was exempt from it, and it became not just really markets, but human nature. As politics is the same way. I mean, the Republicans don't keep control all the time. They'll flip to the Democrats, then they lose, it flips back. So you have an oscillating trend in everything, every market, whatever.
And you've talked about this a lot, the Machiavellian, humans don't change. We all have the same passions over and over again. And that's kind of what you're speaking of here in the cycles. And that's why, this is kind of leading me into the next question, which is with that thought in mind and at the core, that is why history is so fractal then? Because we are...
I just wrote a piece yesterday on Greece. And you have a tremendous amount of Greeks withdrawing money from the banks and just keeping cash. Why? Because they're afraid of devaluation, etc. All right, and that piece on the website, I put a picture of a pot of Roman coins that were just discovered, some 50,000 coins in it, and it's also from the same period of a very political uncertainty, etc. And so human nature never changes, and Machiavelli is correct.
Right.
If you're worried that the government's going to devalue the money or it's not going to be worth something, you're going to hoard it. Right. I saw that's how I got started, where people just gathering silver out of the coinage. Eventually, I became aware and understood that's Gresham's law.
Right.
Bad money drives good money out, which is exactly what happened. That's what I was doing when I started.
Right.
You end up with a money supply of non-silver because everybody grabs the older ones and the better quality, and they hoard it. So these things don't really change. Doesn't matter what century you're looking at.
Right.
Most of the Roman coins that are around are primarily from the 3rd century, which was an economic disaster.
I've got to ask you, have you ever been to the Malibu Getty Museum out there? They've got a little section in there right on PH1 that's got a room with all the currencies really going back even 5,000, I think as far back as 5,000 BC, but exactly what you said, I noticed that same thing, and I was there last in January of 2010. The amount of Roman coins in the 200 to 500 AD area.
That's your most common period. You can buy things, not the greatest quality, but you can buy them for as little as like $10. Because they are they were produced in very large quantities. Okay. But the primary issue is that people tend to hoard during periods of political uncertainty. So, what the survival rate of Roman coins from the 3rd century is the equivalent for what we're seeing in Greece right now, with the Greeks all hoarding and taking money, like 17% of the money supply has been withdrawn from the banks.
Right.
Already, that's a pretty big, sizable chunk. World War I, World War II, people hoarded, all kinds of things, from art to all kinds of tangible things. So it's a repetitive human nature. You get into any kind of a political uncertainty, and that's what happens. It's the same reason why you have corporate cash at record highs right now.
Right.
You have too much political instability. You have politicians arguing, should we raise taxes? Should we not raise taxes? And they don't understand. You can't have this kind of activity. Tax rates should not be a yo-yo. If a company is going to build a plant and manufacture cars, etc., it's just like a person. You don't go sign a rent to go rent an apartment and there's a clause in it and says, oh, by the way, if the landlord happens to be short of money, he can raise your rent anytime he needs to pay a bill.
Right.
I mean, you're either paying a flat rate or, that's your rent, and yes, I agree, or it's not. So with that in mind, and where Greece is, and all the austerity measures, and again, this is a topic that's current and something that you've been talking about. Again, what do you think the best resolution is? I mean, you've stated in public before the resolutions that you think are best, whether it's Greece, etc., Portugal, the pigs, U.S., is either fail, nonlinear, or inflate. And you say with the failure option, war typically follows, and you say with the inflation situation, obviously we know what happens there. It's kind of what you're saying right now, which is people tend to hoard, and the reversal happens, unintentionally this way. Is that kind of where we are? Yeah, I mean, I think that's also why the stock market's going to, the U.S. market's going to move to new highs, etc.
Right.
You have a tremendous amount of cash sitting out there that has been afraid to invest. They don't know where to invest. They've been waiting for politicians or, with taxes going up 25%, they not. I mean, you can't expect companies to start hiring people when they have such an uneasy feeling of what are going to be the rules next year.
Right.
You need stability.
Right.
And, this political yo-yo that we have is pretty bad.
Yeah.
But most of the problems that we really have on a global scale, you have to really cut through all the political rhetoric. And it sounds very nice, to say, oh, let's tax the rich, let's do that. And they say, oh, they really care about the poor, they feel their pain. If you look at the facts, about 70% of the total national debt, some $15 trillion, is interest accumulated. It didn't go to anybody to create jobs. It didn't go to help the poor or the elderly. We're basically in a charity where, okay, fine, you donate $10 and you're lucky if $1 actually gets down to the bottom line.
Right.
Because they're taking everything.
Right.
And they want to say that, oh, we're going to make the rich pay, etc. It sounds very nice. Let make somebody else pay other than me. But, 70% of the entire national debt went to interest.
Right.
And 40% of the debt is held by foreigners. So the money actually leaves the country. It's not even taxed.
Right.
So I don't know what, a lot of this sounds good. It sounds like rhetoric. I was in Australia and they passed, everybody was cheering the luxury tax. And the slogan was, we're going to tax those Ferraris, French wines and fur coats. And everybody cheered. Yeah. And they passed it. And what was in it? All electrical products. So, I mean, I only saw like 2 Ferraris in Sydney all the years I've been there.
Sure.
It was certainly too warm for a fur coat, and anytime I went to a restaurant, they always gave me Australian wine, never French. So, yeah, but it was a great slogan.
Yeah.
And they got everybody to say, yeah, it's tax the guy that makes more than me. But who is that? And then you find out it's really you.
Right.
So,
with the Greece situation, listen, I grew up in Detroit, and I've seen the slow death spiral that's happened there and continues to happen. I think Detroit is a mirror for what's going to happen as a microeconomy in many, many parts. But so how do we get off this want for the linear path that everything must be good? Nobody ever falls down, skins their knee. Nobody ever fails, because in essence, I think we both agree, and I'm not trying to put words in your mouth, but you tell me if you would agree with this, that failure is actually the best thing, or, slip and falls, as you said in the 60s, every 2 years we kind of had this slip and fall, but that creates that capital to come from the sideline and really seek that true value. But when we're in a situation, as you're suggesting, that nobody knows, where we're going to be tomorrow with taxes, with politics, and the rhetoric, et cetera. And I kind of think, in a strange way, in my 20 years of trading in markets, there's been no time that I've ever felt so weird and eerie where, again, I don't, the edge, if you will, if there ever is an edge, but, that's why we play this game, it's really tough to figure out anymore unless you're, I'm not getting memos from the inside of those that are, that know what's going on. So I'm just a small guy out here trying to make a living.
Well, don't feel so bad, because when I go to Washington, they're asking me what's going on because they don't know either. I mean, there is no game plan. And, they asked the Fed just last month, what's the alternative? Do you have plan B if the euro goes? And the response is, no. We don't think it will.
Right.
So we are really in a crisis management all the time. There is no long-term planning. Because of the elections coming up, I can tell you I've been told flat out, right, absolutely nothing will take place in Washington.
Yeah.
Nothing.
And I'm totally in that camp. Nothing will happen, right?
Nobody will risk their career and then lose, possibly if it failed, an election. So I'm of the opinion that the only way to really straighten out the problem is that there do have to be term limits, one time only, that's it. Fine, you can increase it from 2 years to 4 years or something like that. But as long as that guy is there and he has to be reelected, he spends half the time doing that. And he won't take a risk on a long-term plan. So I really just don't see it. I don't think our system is set up really to deal with actually running an economy. I think politicians should never be allowed to even touch it. Because it's always politically manipulated one way or another. I mean, the unemployment statistics, they're a joke anymore. If you stop looking for a job, you're not part of the unemployed. I don't know where you come up with that one at.
Right.
In 1980, when interest rates were going up to 17%, 40% of the CPI was real estate. So they took that out, replaced it with rents, which are mostly controlled. So, okay, fine. So you'll never see the inflation index at 17% again. Never.
Right.
It's impossible.
Right. As long as you have the government, either choose your side, it doesn't matter. Either side will continue to massage and manipulate the numbers so that, again, we appear to be linear moving, in the good things up, and nonlinear flattening in the bad things down, just as what you're mentioning here.
Look, I've been on Capitol Hill, a lot over the years. I don't really see any difference between a Republican and a Democrat behind the curtain. It's always their self-interest. They stand up and make it sound, one's after the rich, the other one's, not. And maybe abortion. But when you get down to all the other real predominant issues, you look at Obama, he stood up there and said he was going to close Guantanamo Bay. And all the terrorists should have trials. He put one guy on trial out of 224 counts. The jury found him innocent at 223.
Right.
He went back to the military trials. He criticized Bush for all his signing statements. He's done more than Bush did. So, it doesn't really matter Democrat or Republican. Once they get in that office, it's always about the bureaucracy and keeping it on the status quo. That's about it.
So let's get back to markets. MF Global, obviously, I think we're now about 80 days from the bankruptcy filing. Lot to talk about here. Money's still 1.2 to 2.5. We don't know what the number is. We don't know where it is. It's an election year. Do we put this into that same box that you're talking about? Nothing's going to get done?
Well, unfortunately, the system is just way too corrupt. Prior to 1985, I had accounts at Drexel Burnham back then. They would call you and say, okay, fine, interest rates, we can give you 16% tonight. Would you like to sell your money? And you'd say yes or no. Sometime after 1985, that all disappeared. And it became, the brokers were largely just taking your money and making money with it and not paying you anything. And then it developed to the point, I think a lot of them started using it as collateral, particularly with London, the way they can do it, hypothecate the assets for collateral to trade with. And that is what has blown up with MF Global. And because England has a different set of rules than the United States. So if the U.S. branch takes your assets and pledges them in England, it signs off on it. The English require that the client agree. So the client becomes the U.S. brokerage branch, not the actual individual clients. So that's how they've been getting away with this for a long time. And you've had at least $1.6 billion that is vaporized. Now, the regulators have known about this all along. And, supposedly, when you have money at a house, the regs say that if the house were to go bankrupt, your assets are not supposed to pay their liabilities.
Right.
That's already in the law. But the problem with New York is largely that the courts always rule in favor of the banks, and you're not going to see anything close to being legitimate. And you got to really wonder. Fine, you might be looking to save the banks so they don't have to pay back all these people, for what MF Global lost. But the law is simple. If somebody steals your car, repaints the car, and sells it to a third party, and you discover that's your car with the VIN number, it's yours.
Right.
It's got to come back. That's the law.
Right.
That guy can't say, well, I was defrauded. I bought it in good faith. Sorry, you don't have the title.
Right.
The car goes back to you. He can go after the guy that sold it to him, but it's your car. It's the same rules with this money.
Yeah, so
it's ridiculous.
So I've noticed, a couple things. I'm just doing some quick checks the last few weeks. The volumes on the futures have dropped significantly. Do you attribute this to MF Global, the Volcker rule, something else? I'm just trying to get your sense.
I would say largely, most of the people that I know, hedge funds, etc. A lot of people are shifting their money because of this. If you're you put money in a hedge fund, and that hedge fund has money on deposit in New York, how are they ever going to get it back?
Right.
I've spoken to hedge funds that used to be in London. They're picking up and moving to Switzerland. So there's a lot of movement going on, and you have Singapore making moves to actually regulate and change so this could never happen over there. And so New York is just too corrupt yet, and the regulators are largely bought and paid for by the big banks. So they're not going to stand up and really defend the little guy. The little guy always loses.
So but this smart money, the large hedge fund money, the investors that you're talking about, does that help them to move it to whether it's an island, Switzerland, away from London to Singapore. Are you content with those movements? Do you think that'll make the markets change for the better?
Yeah, I think so. I think that, New York used to be the financial capital of the world. It is no longer.
Where do you think it is
more
now?
volume taking place elsewhere.
Where do you think that is?
So
if you had to pick a place, where would the hub be now?
It's still a little diverse yet. I think that historically it will go back to Asia. Whether it ends up in Shanghai is a interesting possibility. China is kind of where the United States was going into the Great Depression. We were the great creditor, and that's what China is right now. So I do think that, we are losing our status. The financial capital of the world migrates as well. If you look coming out of the Dark Ages, it really began with the merchants in northern Italy. You had Genoa, Venice, and Florence. The Medicis, etc. Then when you have the great sovereign defaults of Spain and France, they really wipe out the Italians. It then begins to move up to the Germans. The Germans get wiped out by the Spanish again. It then migrates really to Amsterdam. And it really goes from Amsterdam to England largely with the Great Revolution and William, of Orange. So they end up with a Dutch king who actually brings the Dutch ways of doing things to England. And that kind of begins to shift the financial capital of the world to England. Now that peaks out by about 1913. Right
before World War II. Yep.
And World War I just really devastates Britain. And then it is shifting to the United States. The United States didn't quite understand it at the time. But by the end of World War II, the United States ended up with 76% of the entire world gold reserves, official reserves.
Right.
So that's how the United States became the number one. But then our politicians, that's why, kind of really messed everything up. You have a lot of people that say, the return to the gold standard would solve everything. It's not true. We had a gold standard. The idea that having a gold standard means they're not going to be able to print more than they have gold, that sounds very nice, but it didn't work the last time either.
Right.
That's why we had the floating exchange rate in 1971, because Nixon had to close the gold window because it would have all been gone.
Right.
So, I think you can't look at indirect controls.
And so do you think, I'm curious, in your fractal analysis, have you utilized fractal work at all in geography, and trying to determine where that power source may be next?
Well, historically, most people don't realize it, but after the fall largely of Constantinople, the financial capital really moved to India. India was the largest economy in the world, which is why the British were always trying to get into India.
Right.
It then migrated to China. And then you have the Great Opium Wars, etc. And then the British largely took it away from Asia. And that's what I think at this stage in the game we're migrating back to there.
Do you think China will continue to grow at 7-8% for the next 10 years then? This China and or India?
Both places have more of the the ethics that perhaps America had in the 50s. It would be a very big loss of face in India to default on a debt or not pay your debts, etc.
Okay.
And I think that, eventually that culture will change and migrate and become like ours, and then that will be their decline and fall as well. But it's every society grows and matures like a child, and then it gets old
and then it reverts
dies.
again. Yeah, then it gets scared.
Exactly.
Climbs under a rock to the extreme, and then finally comes out for sun again. So,
the West, our biggest problem that's destroying Western culture is this whole Marxist idea. It's one thing to say, we should be helping the elderly, etc., and I think everybody would agree with that.
Right.
But it's something else to say, well, vote for me and I'll make this happen, and you don't really pay for it. All you do is borrow.
Right.
And so, everybody knows, Social Security turned negative in October, so it means they're going to be always paying out more than what they have in it.
Yeah.
They promised all these things, but then nobody ever put any money away.
Right.
And so nothing's funded. And our problem in the West is that they borrow year after year. There is absolutely no intention of ever paying anything off. So, everybody's down on Greece, but Greece is just a precursor.
Exactly.
Is anybody else doing something different than Greece is doing?
Well,
no.
This is why I say, you look at Detroit, what's happening in Detroit is the exact same thing that's, it's been happening for a long time in Detroit, before Greece, and so it's been there before. We've seen this game and we know how it's going to play out. So the 2008 financial crisis, due to all these things that we've just kind of set up and allowing New York to play with other people's money at no risk, and in essence, we all agree, again, we're there. Was that it? Was that a panic? Or are we still in a deep recession? Do you think markets are going to be higher? You said they're going to be higher, but they're going to...
What you're getting into now is largely the classic historical shift in where does capital invest. When, after the Great Depression, we ended up in what we call a public wave, meaning that your confidence is much more in government than it is the private sector. You don't trust the corporations, stocks, that's kind of, dodgy, risky, etc. So you have people buying savings bonds and all that, very nice. And then that era begins to come to an end. And that's really what caused the takeover boom of the mid-'80s. Because when you looked at, we published charts on it that, plotting the Dow as a percent, book value as a percent of the high, you ended up at historic lows in 1977, below that of the Great Depression. And so here we are again with many stocks that are paying dividends of 5 to 8%. You have resource stocks even down in Australia that are selling at half their asset values. So capital has been shaken from the 2007 to 2009 debacle, initially because of they were blaming, the private sector again and speculation, etc. But that has then migrated off into the government side. So the 2007 high was largely in the worst sector you could have, which is the real estate market.
Right.
And a lot of people don't quite understand that the stock market is the one out front. It's the one quoted. It's a central clearing place, so you can see the prices go up and down visually. Real estate isn't like that. real estate isn't a central, clearinghouse. It's diverse depending upon the quality of the house, the region, where is it at. So you don't have a central price to show up and down as easily as you do in other things. But the real estate market absorbs more money than the stock market. And its function has been, particularly coming out of 1955, was that's your savings.
Right.
So a lot of people, they felt that their home was their retirement.
And you've got generations, multiple generations of people who still believe that.
Yes. And they will spend more money as long as they think that they got an extra couple $100,000 in profit in the house. Mm-hmm. Now you're finding people that have lost that cushion.
Right.
And in many cases, they're people that have mortgages, what they're paying in mortgages are even more than what the equivalent rent would be, because in effect, whatever they're paying is really rent because it's not going to any appreciation in capital.
Right.
So
how does
the real estate market...
Yeah, how does that story transition and end? I'm curious what your thoughts are.
That becomes the worst one. When you get the biggest economic declines is when you undermine that market. Taking the stock market down to 10 cents on the dollar by itself is nothing. It doesn't wipe out society. It doesn't destroy capital formation.
Right.
If you do that to the real estate market, you're affecting virtually everybody. And then you're doing it to the sovereign debt markets. That's where everybody's pension money is.
Right.
So these are the two real big markets, and the stock market is really just the fledgling alongside it. So although it gets all the heat and the publicity, the Dow's up this or down that or whatever,
right.
It's not really an indicator of the economy per se. It can be a leading indicator at times, but the reason it's going up right now is because capital is beginning to become concerned with government debts. Should they diversify now away from sovereign, bond issues? Real estate is not necessarily easily held in portfolios today for a valuation perspective. That was a lot of the problem of the debacle we went through. They were creating pools out of real estate, and then that became a quotable security. But the problem with real estate is you can't pool it.
Right.
Once you start doing that, and then they were slicing them up and dicing them, legally somebody has to have the mortgage.
Right.
So a lot of people have found that they're able to stay in houses for 3-4 years, don't have to pay anything because they really can't foreclose on it. And you say, well, okay, fine. You want to foreclose? Show me the mortgage. And they can't.
Right. So, are we early into that stage of deleveraging still then?
I think that there's still a lot more deleveraging to come. Not as bad as what we saw per se on the real estate side, but you have a lot of leveraging on the debt markets. Sovereign, that's also what took down MF Global.
Right.
So you always have a deleveraging aspect in these types of declines. The bulk of it comes largely the first 2 years because people can't afford to hold on to it.
Right.
But we're still more in a deleveraging side from in those sectors. But you have a tremendous amount of cash also among funds. Corporations are at record highs in cash levels. And you can't earn anything in banks.
Right.
The Fed has been cleverly bailing out the banks. A lot of people think that or pretend that the Fed has been monetizing. That's highly questionable. What they've been doing really by keeping interest rates so low is you go to a bank and they're offering 0.7% for a 3-year CD. Ask them for a 3-year car loan. They generally want 4%.
Right.
I've never seen the historic spread between cost and what they're asking for at these kind of levels.
Sure.
I mean, in 1980, when interest rates were 17%, if you apply the same ratio, that would have been that, okay, fine, they're paying the Fed 17% and they're charging you 9,700%.
Right.
I mean, it's a tremendous profit.
Yeah.
Tremendous.
Yeah.
So a lot of people think that the Fed has been monetizing, and it's not quite what they think. So if the banks had passed on those low interest rates,
right,
then the economy, I think, would be perhaps stimulated much more.
Right.
But they're not passing it on. So all it's really stimulating are the banks. It's increasing their profits, and it's really just the backdoor way of still bailing out the banks again.
Right. Fascinating. I mean, it's fascinating because, my follow-up question to you, and you kind of answered there at the end, was, therefore, even though these rates are still low, they're still really not even lending in quantities for houses / cars / growth in your business. So,
yeah, if you're a small business owner, I mean, good luck trying to get a loan out of these guys.
Right.
And it's just not happening.
So is that, I mean, so again, you see a higher stock market, small piece of all these asset classes, real estate, let's call it basing, flatlining, whatever you want to say. It's kind of on its last legs, last
Some
breath.
areas will rebound going into probably about late 2015 at this stage. But those are select areas. There are also a lot of places that still have a tremendous backlog of foreclosures.
Mm-hmm.
So that's going to keep those particular regional areas suppressed in price.
Right.
So it's very, very diverse in real estate. It's not one giant market you can say, oh, it's all up or it's all down. And so it's very, very diverse.
Still, regional and depending on where you are. So,
it depends upon the market in each area.
Martin, let's talk a little bit about a film. There's some trailers going on out there. Martin Armstrong /movie.com. The movie looks like right now they're titling it The Forecaster. As you said, you are maybe one of the focuses, not the only focus in the movie. Give us a little background. The trailer for me is fascinating, and hopefully if you enjoyed this interview, I think you'll like this movie. Give us a little taste on what you know is happening. Again, who the filmmaker is, what's going on.
The filmmaker is a pretty renowned European documentary guy. His name is Marcus Vetter. He's won a lot of awards. His last big film was The Heart of Janine. I know he's simultaneously doing one on The Hague. With this particular film, I think he's largely running around the world doing all kinds of interviews and stuff like that, which are not really in this trailer that's out right now. But I may be the center in a dust storm, so to speak. I think he's largely showing the financial crisis is probably the big issue. And all the nonsense that's really been going on, I think, in the United States, is very important. So he's doing a very, a global film. I say there's people appearing from everywhere from Paris to Singapore. I mean, they really are flying everywhere.
Right.
So the trailer came out because largely there was a conference in Vancouver. They wanted to show it, and once it was out, that was pretty much it.
Right.
And it's been, kind of viral since. So,
are you excited? Are you excited about the project?
Well, I think that as long as it, you never know these things until they're out. But from what I can tell, it is going to largely focus on the whole issues. Of the financial crisis, what we face going forward, and what are the solutions. So it has focused on me largely, I guess, as the initial narrator, or not a narrator, but the focal point, mainly because I think that when the euro was being formed, the committees came to our conferences in London. I had officially put out pieces and saying, "Listen, guys, if you do this, it's gonna blow up." So I've always worked fairly close with governments in the sense that we don't accept money from them. I think they always want to know what we've got to say, largely because it's because we don't accept money from them. You're going to get a candid answer. Unfortunately, a lot of the so-called think tanks, they just put out whatever it is that they want them to say, as long as you pay them enough, and that's the way it is. So. There was a piece I put out, and I would say what I was able to accomplish with Europe was to get them away from the idea that you had a single interest rate as well. The problem with it was that they were leaving each individual state with its own debt. Now, from a trader's perspective, and I don't think I was unique. It's just that a lot of the large traders that dealt with those things worked for the main banks and hedge funds, and they could not come out and make public statements. But effectively, what Europe created was as if all 50 states had the right to print federal debt. Mm-hmm. What an absolute chaos that is.
Right.
And from a trading perspective, what they did not realize, and this is why I think politicians should be barred from fooling around with this kind of stuff. And I told them, I said, if you leave this debt in the hands of each country, what you're going to create is largely a virtual currency. That's it. It's not going to be a one world currency. You're going to convert the bond markets into the currency markets, and everybody's going to trade them accordingly. And they didn't listen to me on that. And now we have a real crisis. So I'm the guy that came out and said, don't do this. So I think that's largely why the European film, that's documented. Everybody knew it, and saying, okay, fine, you didn't listen to this guy. He told you were going to blow it up. And here we are.
Here we are.
It's blowing up. But I think any trader would tell you, and I think now they're beginning to understand, you want to sell Greece, you just sell the Greek bonds.
Right.
You drive the interest rates up dramatically. It becomes a virtual drachma. So you didn't create a one world currency. You had to create a single national debt.
Yeah.
If they did that, consolidated all the debts together, and then each state, any future borrowing it did would be on its own accord, that would have worked. But now you take that mistake, and now you tell the banks, okay, fine, your reserves have to be in these euro government bonds. Now, to be politically correct, what do? Oh, well, you have to be fair, and you have to have some Greek bonds, French bonds, etc.
Right.
So now what you've done is you now have a sovereign debt crisis Greece, Portugal, Spain, Italy, etc. And now that undermines the banking system.
Right.
So, I mean, it becomes such a convoluted mess. And unfortunately, the politicians will not deal with it because a politician will never admit that they made a mistake.
Right.
So we keep creating more bailout funds and bigger bailout funds to keep a flawed system going that's just going to collapse anyhow.
If we did have some brave soul somewhere that was able to say we need to take our medicine today to get better tomorrow, could we get better?
Well, I think that we're going to have to, there are solutions that I've presented for their film, and we are faced, either we default, in which case everybody's pension funds are wiped out, Social Security's gone, that's it. Everything's finished.
Right.
Or we inflate out. That's what's on the table.
Right.
So the solutions are trying to creatively create a third option between these. And we inflate out largely as what's been happening. You create more and more bailout funds. You then have to bail out the banks. I mean, you just keep going and going. It's like the pink bunny. I mean,
but it can't go on.
I don't know when you're going to stop.
But so what disrupts that? What changes that? I mean, the inflation model can't go forever. Something happens.
Well, I will have a book out probably by the early next year. If I can get it done earlier, I'll have it out. I started, it was going to be just a report. I took Adam Smith's last chapter on public debt. And he basically said in there, I don't really understand why anybody considers public debt quality, because everybody's always defaulted.
Right.
But he doesn't give a list of it. So I thought, okay, fine. I knew about Spain and various different, France, etc. But what happens is that I started putting together a list. And as I did, what happened was I ended up with unbelievable, I mean, I couldn't find anybody other than one country, but every country defaulted. And some of them were absolutely dramatic. The city of Maine, for example, was where the Gutenberg press was, entrepreneurial, etc. And what happened was, the city was making a lot of money. Politicians started borrowing. They wanted more, faster. And they kept raising taxes. They drove the rich out of the city. So what they ended up with was kind of like Detroit or Philadelphia, that you end up with the people consuming and nobody paying.
Right.
So they ended up defaulting. The creditors came in. They sacked the city, burned it to the ground, and the Pope excommunicated everybody. The default took place when they came up with a bond auction, and what happened was nobody
showed up.
They couldn't roll it. Nobody was there to buy them.
Right.
So unfortunately,
there's my answer, Martin.
That's the answer. When you see they can't sell the bonds, that's when the crisis takes place. We had that for a little bit in October in German bonds. The central bank had to buy them up. You can get away with that a few times, but when nobody shows up at the party and you're the only one all dressed up and walk in the door and say, voila, here I am, and they're not there, that's when everything falls.
Well, listen, I'm going to end it right there. No pun intended. But
okay.
I've gone over my limit, and I want to respect your time. And we'll have to do this again and have a continuous discussion here, because This is fascinating. I really appreciate your time, Martin. And thanks for coming on. Good luck with the movie,
No problem.
The Forecaster. I think it'll be fantastic. The trailer's out there. Look for it. And again, we'll be back here. I'll have you back on again soon.
Okay. Take care.
Thanks, Martin.